In 8 months, Ripple spent $2.45 billion acquiring 3 companies, $1.25 billion for Hidden Road, a prime broker clearing over $3 trillion annually, $200 million for Rail, processing 10% of all global B2B stablecoin payments, $1 billion for Treasury, a 40-year-old treasury platform processing $13 trillion in payments for Fortune 500 companies. 3 acquisitions, $2.45 billion deployed. American Airlines, Goodyear, Volvo, all now inside Ripple's ecosystem. XRP is at $1.45. If you built a bridge between stablecoins, cross-border payments, and Fortune 500 corporate treasuries, and the market priced your native asset at less than the cost of a cup of coffee, something is either catastrophically wrong or catastrophically mispriced. Let's find out which one it is. Here is what makes this moment structurally unusual. Tom Lee of Fundstrat, the analyst who first recommended Bitcoin to institutional clients in 2017 at 1% to 2% allocation, when almost nobody in traditional finance would touch it, is now saying that 5% to 10% is the appropriate allocation for a median investor in 2026. And for younger investors, 20% or more makes sense. That is not a fringe position. Fundstrat's research is used by global asset managers representing 80% of active assets under management. When Lee moves his allocation recommendation from 1% to 20%, that is not enthusiasm. That is a structural recalibration of how an entire generation of institutional money is being directed. And the numbers behind that recalibration are not speculative. They are documented in filing rooms and regulatory disclosures right now. So here is the question that the $2.45 billion in Ripple acquisitions and the Tom Lee allocation shift force simultaneously. If Ripple has now built the most complete digital asset infrastructure stack in existence, payments, prime brokerage, treasury management, stablecoin rails, 60+ regulatory licenses across jurisdictions, and institutional capital is being recalibrated toward crypto at a scale never seen before, what exactly is the mechanism that connects those two realities to XRP's price? And why hasn't it connected yet? This is XRP News Flow Signals. We track the documented institutional and regulatory mechanics that determine where this asset actually moves. Not the sentiment cycle, not the price candles, not the social media narrative. And right now, those mechanics are describing a gap between what Ripple has built and what XRP's price reflects. A gap that has a specific structural explanation and a specific trigger that closes it. Let me walk you through both. Let's map the 3 acquisitions precisely, because most coverage treats them as separate headlines. They are a single coordinated strategy. Hidden Road, $1.25 billion, April 2025. Hidden Road is a multi-asset prime broker clearing over $3 trillion annually with more than 300 institutional clients. Prime brokerage is the infrastructure layer that allows institutional investors to execute, clear, and settle large positions with credit, leverage, and custody services. By acquiring Hidden Road, Ripple gained direct access to the institutional trading infrastructure that hedge funds, asset managers, and banks use to move capital. Ripple Prime, which makes RLUSD the first stablecoin to enable cross-margining between digital assets and traditional markets, was built on this acquisition. Rail, $200 million, August 2025. Rail is a stablecoin-powered global payments platform forecasted to process over 10% of the $36 billion global B2B stablecoin payment market in 2025. The platform supports USD, EUR, GBP, INR, MXN, AED, and other currencies, and gives businesses access to stablecoin payment rails without requiring them to hold cryptocurrency on their balance sheets. Rail's CEO Banu Kohli confirmed that the integration adds RLUSD and XRP as supported settlement currencies alongside the existing USDC and USDT. That is not a feature announcement. That is XRP being embedded into the payment infrastructure of a platform processing billions in annual B2B volume. G Treasury, $1 billion, October 2025. G Treasury is the global leader in treasury management systems, with over 4 decades of experience serving Fortune 500 clients. The platform processes approximately $12.5 trillion in payment volume annually and serves companies including American Airlines, Goodyear, and Volvo. On April 1, 2026, Ripple launched 2 new products built on the G Treasury platform: digital asset accounts and unified treasury. Fortune 500 CFOs can now hold and manage XRP and RLUSD directly alongside their cash in the same dashboard they use for bank accounts, the same workflows and audit trails. Read those 3 acquisitions in sequence and you see what Ripple built: a complete institutional stack. Payments in, payments out, prime brokerage in the middle, corporate treasury on top, and XRP embedded as a settlement asset across the entire chain. The infrastructure is not coming, it is live. But that's not even the most important number in this story. What I'm about to show you is the scale of institutional capital that Tom Lee and the broader analyst community believe is about to enter the crypto market, and what happens when even a fraction of that capital arrives in an ecosystem where Ripple has already built the only compliant, regulated infrastructure ready to receive it at institutional grade. Let me be precise about the institutional capital thesis, because the numbers being cited in the space are real, but the framing around them is often sloppy. Tom Lee first recommended Bitcoin to Fundstrat clients in 2017 at a 1% to 2% allocation. That position has since produced 100 times returns for those clients. His current position, 5% to 10%, is appropriate for median investors in 2026. For younger investors with time working in their favor, 20% or more is consistent with BlackRock's own mathematical calculations. That shift from 1% to 20% is not a personal opinion. It is the directional signal from one of the most widely followed institutional research firms in traditional finance. Fundstrat's research is used by clients in 23 countries and asset managers representing 80% of active AUM. Pension funds, insurers, and sovereign wealth funds are beginning limited allocations through ETFs and tokenized instruments. Recent disclosures show European and U.S. pension plans testing exposures below 3% of portfolios. At least 15 U.S. state government pension systems have now added BlackRock IBIT to their alternative investment portfolios. This represents sticky capital. Unlike retail traders who might sell on a 10% dip, pension funds operate on 20-year horizons. Bitcoin ETF assets under management are expected to reach $180 to $220 billion by year-end 2026, up from approximately $100 to $120 billion currently. Assets under management across all crypto ETPs are expected to surpass $400 billion by year-end 2026, doubling from roughly $200 billion. Now apply that institutional allocation trajectory to XRP specifically. XRP currently represents approximately 4% to 5% of total crypto market capitalization. Standard Chartered, the most precise institutional voice on XRP, projects the asset reaching $8 by end 2026 under a scenario of continued institutional adoption and ETF inflows. The bank's analyst, Jeffrey Kendrick, has estimated that Clarity Act passage alone would drive $4 to $8 billion in additional XRP ETF inflows from institutional capital currently waiting for statutory legal cover. The institutional capital is not a future event. It is arriving right now, through ETFs, through pension disclosures, through state-level alternative investment allocations. The question is, how much of it routes to XRP specifically? And that answer depends on one variable. Now, before you get too excited, and I say this because this is the detail that almost no coverage is addressing honestly, there is a specific reason why Ripple's $2.45 billion infrastructure build has not yet produced a corresponding XRP price move. And it is not a flaw in the thesis. It is a structural gap that has a documented closing mechanism. And what Ripple's CFO said publicly this week makes that closing mechanism more visible than it has been at any point in the last 2 years. Let me be direct about the structural gap between what Ripple has built and what XRP's price currently reflects. The G Treasury platform went live with XRP and RLUSD integration on April 1st, 2026. The platform processed $13 trillion in payments last year with zero crypto involvement. The April 1st update is the first product integration since Ripple's $1 billion acquisition. And XRP now lives inside the same treasury infrastructure that Fortune 500 companies use to manage their cash. That is a genuine structural shift. A CFO at American Airlines can now see their XRP balance on the same screen as their operating cash. Same workflows, same audit trails, same compliance framework. And yet XRP is at $1.45. The reason is not that the thesis is wrong. It is that institutional treasury adoption operates on a different timeline than retail speculation. A Fortune 500 CFO does not allocate to a new asset class because a product integration launched. They allocate after their legal department reviews the regulatory classification, after their board approves an updated investment policy statement, and after they have confirmed that the asset's legal status is durable enough to survive a change in administration. That last point is the gap. XRP's commodity classification, confirmed jointly by the SEC and CFTC in March 2026, is real and documented, but it is not statutory law. A future administration can reverse it without a congressional vote. The Clarity Act converts it to statute. And Monica Long, Ripple's president, has said, as regulations become more clear and the space has grown and matured, this opportunity for stablecoin payments is really ripe. She confirmed the company has institutional partnerships locked behind NDAs that are contingent on regulatory clarity. The G Treasury integration put XRP inside Fortune 500 Treasury dashboards. The Clarity Act is what makes those CFOs willing to actually hold it. If you have been watching Ripple build this infrastructure and wondering why the price hasn't moved the way the fundamentals suggest it should, you are asking exactly the right question. And the answer is not complicated. It is structural, and it has a closing date. This channel tracks that closing date, the institutional positioning data, and the acquisition mechanics every week. Not the sentiment, the structure. Subscribe now and turn on notifications, because when the Clarity Act markup lands, when the next Fortune 500 company discloses an XRP treasury position, or when Rails volume data confirms XRP is being used as a settlement asset at scale, that analysis will be live here within hours of the disclosure. The infrastructure is already built. The legal framework is weeks away from resolution. You want this framework before the price reflects it. Let me give you the full consolidated picture, because most coverage is reporting each piece separately and missing the architecture. Ripple in 2026 is not a blockchain company that has XRP. It is a financial infrastructure company that has built a complete institutional stack. The payments layer, Ripple Payments, with over $100 billion processed globally, and Rail adding 10% of all B2B stablecoin volume. The brokerage layer, Hidden Road, clearing $3 trillion annually with 300+ institutional clients. Now with Ripple Prime, enabling RLUSD cross-margining. The custody layer, Ripple Custody, used by Deutsche Bank and Kyobo Life Insurance for tokenized asset management. The treasury layer, G Treasury, with $13 trillion in annual payment volume from Fortune 500 clients, now live with native XRP and RLUSD capabilities. The regulatory layer, 60+ financial licenses across jurisdictions, a federally approved National Trust Bank charter through Ripple National Trust Bank, and a domestic money transmitter license network. Ripple's total acquisition and strategic investment spend now exceeds $3 billion. Hidden Road at $1.25 billion. Rail at $200 million, and G Treasury at $1 billion represent $2.45 billion deployed in 2025 alone. That is the infrastructure empire. Now, here is the honest assessment of what XRP's role inside it currently is versus what it becomes when the statute arrives. Right now, XRP is one of several supported assets. Rails supports USDC, USDT, RLUSD, and XRP. G Treasury's new digital asset accounts include XRP alongside RLUSD. Hidden Road's cross-margining focuses on RLUSD. XRP is embedded. It is not yet the primary settlement asset. After the Clarity Act, Ripple's on-demand liquidity product, where XRP is the actual bridge asset rather than one option among several, becomes the legally durable settlement mechanism that institutional compliance departments can approve for large-scale deployment. That is when the infrastructure stops being a collection of tools that supports XRP and starts generating direct, measurable, transaction-level XRP demand. The infrastructure is built. The regulatory framework is the switch. Let me close with the 3 documented signals that will confirm whether the infrastructure to price gap is closing in the specific near-term window that matters. Signal 1, Fortune 500 Treasury disclosures. The G Treasury integration went live April 1st, 2026. The first Fortune 500 company to disclose an XRP position in its quarterly Treasury report through Ripple Treasury's unified dashboard is the signal that corporate Treasury adoption has moved from infrastructure availability to actual deployment. Watch the Q2 2026 earnings reports. That is the first filing window where it could appear. Signal 2, Rail volume data with XRP breakout. Rail's CEO Banu Kohli confirmed that XRP is now a supported settlement currency alongside USDC and USDT. When Rail's volume disclosures or any third-party data on B2B stablecoin flows show XRP as a measurable percentage of Rail's $3.6 billion in annual volume, that is the first real-world confirmation that Ripple's acquisition is generating transaction-level XRP demand. Not theoretical, documented. Signal 3, the Clarity Act markup date. Everything above, the G Treasury integration, the Rail volume, the Fortune 500 disclosures, is building toward a statutory event that makes all of it legally permanent. Senator Lummis has called this the last chance before 2030. The markup that has not yet been scheduled is the single procedural event that determines whether the switch flips in weeks or years. Ripple spent $2.45 billion building the infrastructure. The statute is the permission slip that activates it at institutional scale. 3 signals, 1 outcome. The gap between what's built and what's priced closes when all 3 arrive. Drop 1 word below. Empire, if the consolidated infrastructure picture landed as the frame you were missing. Switch, if the statutory trigger is your primary variable. 1 word, it shapes what comes next. XRP News Flow Signals. Data, not noise. Structure, not hype. See you in the next one. Not financial advice. Always conduct your own research.